It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I am your host. I'm also one of the CFPs on the program. With me in the KFG studios, my business partners, sometimes friends, Kevin Korhorn and Josh Gregory.
Well, even though pensions are more rare than they used to be, if you have one, choosing how to draw it is one of the most important financial decisions that you're going to make in your lifetime. So we're going to explain your options and help you make a wise choice in this hour.
That's right. If you have any questions for the program, we're hoping, I told the guys, listen, talk fast, stay on point. We got to hit some questions from fans of the show. If you want to submit some, you can do so a few different ways. Call or text 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com. There's a spot to put questions right there on the right. Guess what? It turns into an email to me, goes right to my inbox. There you go. And then all over social media. We get lots of questions every day on the YouTube channel, but Facebook as well, or Twitter. You can connect with us there. Wherever you're at in social media, we are there as well. Engage with us. Submit questions there as well. All right, let's talk about pensions, okay? And I guess the first question would be, they've kind of have they run their course? They've been extremely useful. Both my parents have pensions, believe it or not, and that is extremely rare. Josh, like you already said, are they going to make a comeback? What do you guys think?
I don't see it personally. I mean, certainly the trends have been less and less and less people are covered by a pension. And in their place, the opposite trend is happening with more of what we would call defined contribution plans, which is just sort of a catch-all category for things like a 401k or a 403b if you work in the schools or hospital or a nonprofit, and other types of plans like that where your employer is defining what kind of contribution you can make, as opposed to pension plans. You think of them as a promise to give you a certain amount of income out there in the future in retirement.
Where your employer's the one funding it, and they sometimes don't even have full control over how much they're putting in for you. They might tell you they're putting in a percentage of your pay, but if the actuaries recalculate and the funding level's too low, the company might need to put in more. And so because of that, and because of how those investments underneath have worked, I also question whether these things will make a comeback. And plus, Jeff Bezos, on behalf of all of us faithful Amazon customers, took those dollars and flew into space, as opposed to throwing dollars in a pension plan. Now, if Jeff Bezos isn't going to do that, who would?
Yeah, and if you look at just the financial impact of a pension, if bonds were paying in the 5 to 6% range, then it might make sense to, pension funds might be able to meet their obligations. With the way interest rates are now, bond funds really are going to have a terrible time keeping up with the demands, and companies, unless it's a company that the main thing they manufacture is cash. Yeah, they're going to have a hard time funding these things.
So if you work for the Federal Reserve or the federal government, your pension's intact, but the rest of us, I don't see it coming back. I mean, in fact, would you say, Kevin, 13% of the workforce has pensions?
I actually have that up right here. If we look at private industry, because you're right, government workers, they've got a different game plan altogether for retirement. But private industry workers, it's 64% have more of the newer defined contribution plan that we were talking about, 401ks and things like that. It's 15% of all other workers have some sort of a pension plan. And there is about 13% of overlap there.
Oh. Where they have both, or they have nothing?
12, it's actually 12% of overlap, where they have both. Okay. There's 3% who have only a pension. So that's very rare to only have a pension available to you.
Yeah, I'm going to say there's about 27% that have nothing.
Nothing. We're going to talk about that as well. We're just dealing with, it's interesting. So if you're goal oriented and you've got a 401k, you might see that contribution limit as a bogey, as a target. I'm going to hit that thing. Well, what if you don't have a 401k? There's no contribution limit on funding other things, a non-IRA. And I was talking to Amy Masters, one of our all-star CFPs here, about how that can be actually demotivating. So we'll talk about that on a different show. But today we're talking about pensions. So we all doubt that they're making a comeback. But for those of you, whatever the percentage was that Josh said, I'm bad with numbers on the show, whatever the percentage was.
I was making them up anyway. So.
I knew 85% of all facts on radio shows are made up. That you still have a pension. Making this choice is one of the most important financial decisions of your life. So what are your choices and which one's best?
You going to teach us, Kevin?
Well, sure. You can oversimplify and say, okay, I can take the money. So if your pension offers a lump sum, this is the fascinating thing, because you talk about what firms do or don't offer a pension, or even a government or teacher. Whatever. The oldsters have certain pensions that the youngsters don't have.
Yeah.
Or because they might both be in the pension plan, but the options for the older folks, or the folks that have been there a lot longer, or say their grandfather, they have different options than the young folks.
Yeah, when these plans were originally conceived and built and then offered to employees, it was almost like too good of a deal that was being offered. The promise was too big for most employers to actually be able to fulfill. And so they started kind of paring it back a little bit over time. And now you're at a situation where most employers, it's like, we can't fund this thing. We've promised too much, and we have to cut back or completely eliminate the pensions entirely.
So I have a choice if I'm going to take the money. I can take the money as a lump sum. If that is an option, then that's a choice. And then I'm at a fork in the road. I can take the money and pay taxes on it right then and there. So if they said, hey, your pension is $2,000 a month or $200,000 lump sum, I could say I'll take the money. It's kind of like the lottery. You win the lottery, and they say, hey, you win $20 million, or you could take $500,000 a year over the next 20. I said that wrong. Anyways, there's a lump sum option for the lottery. You got to play to win. But with the pension, you can take it as a lump sum. Typically, what most people do is take that money and roll it over, because it's coming out of a qualified plan. When the company put the money in to the pension plan, they got a deduction on that. Yeah. So the money that's in the pension fund has never had taxes paid on it. So whether you take that as $2,000 a month or you get a $200,000 lump sum, there's going to be there's a tax IOU associated with that. So what a lot of people typically tend to do is say, if I'm taking it as a lump sum, I'm going to roll it over into my IRA. And so,
because you're postponing the tax on that, then
exactly. You could take it and pay tax on it. Most of the time, that is not the
wise thing to
do
at all.
Yeah, because this could be a huge sum of money that all of a sudden is being taxed in 1 year. And maybe it's the year that you retired, so you also had some wages or some earned income on top of that, and you can really get hit hard. So some plans, many plans, offer the lump sum option, and you can either take it as cash or you can roll it over. All plans give you the ability to take a monthly stream of income for the rest of your life, or some period that you choose, which we can unpack in our next segment here.
Which we will, because it's almost like you've got two choices. Take it lump sum or take it monthly. Well, if you take it lump sum, you can take the cash or roll it over. If you take it monthly, you can do it just on your life only or with a beneficiary attached. We're going to break that down, that and more, coming up on The Wise Money Show with Korhorn Financial Group. Hey, YouTube, thanks for being here. This is The Wise Money Show. You're at The Wise Money Show channel. What you're watching right now is our weekly 1-hour talk show. Airs right here on this channel, 10 a.m. Eastern Time. every single Saturday, and then also on podcast at the same time. And then all throughout the week, we've got Next Wise Step videos. They are more manageable, 10 minutes, 8 minutes, something like that, taking one financial concept, applying it directly to your financial life, helping you be wise with your financial life. If that's what you're all about, make sure you hit that subscribe button, turn on notifications. If you like the content, leave comments below as well. Thank you.
Wow, that's got some nice bass to it.
Yeah.
Okay,
that in
so
my chest.
are we gonna? So what is next?
We can expand on that, and then if you have lump sum option available, when is that best?
Yeah, because I think of the Pension Benefit Guaranty Corporation, and they're South Bend is famous. The ERISA came out of South Bend basically. Mm-hmm. Because there were a number of people, and I remember reading the article about the 3-time pension losers, where I worked at this company for 10 years, qualified for a pension. They went out of business. I don't get a pension. I worked at the next company for 10 years, qualified for a pension. They went out of business. I don't get a pension. There are guys in town that did that 3 times over.
Wow.
If there's things to be known for.
That's
probably not one
the
of
group
them.
you want to be a part of.
All right, we'll get into it. If you have the option, well, number one, if you have a pension, okay, and then if your pension allows for a lump sum, should you take a lump sum or should you take it monthly? How do you make that decision? We're helping you with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. All right, so very, very, very few people have pensions these days. You might have an old pension. I think that's still quite common if you're considering retirement right now. I don't know what the percentage are of that. Maybe, I don't know, what would you say? 40% of maybe less than that. Have an old pension, frozen pension. Well, anyway, how do you draw it? What's your choice on how you want to use that pension? Take a lump sum or take a monthly payment amount? Okay, if you've got a lump sum option available, when would you take? When is it wise to take lump sum?
I've helped a lot of clients, we all have, with this type of decision. And one of the themes that often comes up where people say, you know what, a monthly stream of income that you can't outlive sounds really good, right? I mean, it creates an amazing base of income. Throw this on top of, Social Security, and all of a sudden, day one, every calendar year, you've got, the income rolling in, you have confidence. But why would someone pass on something like that? One scenario is if you don't trust your employer. And I've seen this before. And, Kevin was at the break sharing some of the historical examples from here in town of employers that went out of business and had not funded properly the pensions. And so these promises that were made over the years couldn't be fulfilled, or at least not in their entirety. And I've had some clients who have said, my employer has had a history of minimum funding the pension. Mm-hmm. And if you're not sure what that means, there are certain laws in place to protect pension holders, future recipients. You've had these promises made to you, and the government has created an entire rule book on how much does the employer have to maintain in this big pool of money that's going to actually fulfill those promises? It's a big pension trust fund that is actually going to generate the income to you in retirement. And how that's invested, how it is funded, these rules kind of handcuff employers. But there is some leniency. Like there's a range of right answers on how much to throw in. And an employer who's struggling financially, they might do the bare minimum. And in doing so, this pension either has to play some catch up because of great investment returns, or they're going to have to contribute even more in the future. But the point is, if your employer is in a financial position where they're not able to fund this fully, the risk is that maybe this trust fund I'm describing doesn't get up to the size that's needed, and part of your pension could be in jeopardy. And many folks choose to just take the money and run in a situation like that.
There's a circumstance happened locally here. If you're listening on YouTube or podcast, we're in northern Indiana, southern Michigan, have a few offices there. And there's a local company that over the past couple of years, their funding level what do you get annual statements, pension participants get annual statements on the funding level of their pension, and folks were watching this percentage drop gradually. And if the funding level got below was at 83%, the company was going to shut off the lump sum option, and that actually was a consideration. As if you're close to retirement and you're hearing those rumors and you're looking around at the economy and the industry and saying, yeah, geez, things don't look that great. I was going to retire in 6 months or in 12 months. Maybe I retire immediately and I take this lump sum, as opposed to not having the option to take a lump sum. And then at the mercy, if it falls below a certain funding level, the company says, hey, we're cutting this thing off completely. The pension goes to the Pension Benefit Guarantee Corporation, i.e. the government protections, and you get a reduced monthly amount instead of even the full amount that you were planning on.
Yeah, it is. That's the planning part that comes in, because you want to have an awareness. If you have a pension, how well is your pension funded? And if you have the lump sum option, do you want to bet that your company is going to stay healthy over the rest of your retirement?
That's right.
Because I look, my dad has a pension, and it's kind of funny because he retired in 2000 or 2001, something like that, and he's still on the payroll.
Yeah.
He's on the payroll until he dies. It is the craziest thing ever. Good on him, but it doesn't seem very sustainable. And if you look at that and you say, all right, if I had an option to do take the pension as a lump sum, what might I be able to do differently? Because you say, hey, if you retire and then you live another 30 years and you take a monthly payment, that might be fine. But if you retire and you had the lump sum option and didn't take it, and something happened 5 years into the deal where you say, hey, instead of having this monthly income, I'd rather have a chunk of money, because that would let me do something. Maybe there's an illness. Maybe I want to do something on my bucket list. Maybe my health is changing, and if I don't do this now, I'll never be able to do it. So it's very interesting when you look at kind of the theology of to lump sum or not.
Yeah. Well, and keep on going in those scenarios. I mean, if you had a major health concern and you weren't going to live out to your full life expectancy statistically, you may want to take the lump sum just purely to preserve that wealth that's kind of got your name attached to it, something that you can pass down to your family as well. So, a lot of people who really value leaving a financial legacy and the estate planning aspect and control of you having the money in your possession, lump sum is a way to go in a situation like that.
I've had some folks that, to me, I think while both of those considerations absolutely are part of the equation, to me, it's more so a cash flow decision first, or maybe my mind just gravitates there first when I'm meeting with clients. Do you need more cash flow than what this pension offers? If so, should you roll it over to lump sum where you have more control over how much and more flexibility on how much you draw out? But a lot of times, folks that we've been doing planning with for decades, they don't need that much income. And I don't want it to sound that way, but like the pension, when you combine it with Social Security, when you combine it with some of the other resources they have, the pension is paying them an amount where you say, well, you're not even going to spend all of that. Therefore, you've got this income that you've got to pay tax on, and then it's just going to build up in the savings account. And some of you might listen and say, well, wonderful, I'll take more vacations. Right, you could. But like in this scenario where, hey, my lifestyle is my lifestyle is my lifestyle, and we just paid the mortgage off and we're financially free. And, we could have this extra $3,000 a month, but we probably only need $2,000 a month. Well, do you take the extra $1,000 and pay tax on it? No. Take it as a lump sum, and then you can just draw your $2,000 a month out of it and manage your tax situation better. So to me, I think it a lot of times it has to do with the other factors Josh and Kevin talked about, but also with cash flow. And I think the big thing connected to each of those is choice. And we are all for freedom of choice. Financial planning and the proactive approach to your financial life is often done so that you've got as many options to consider as possible when you're facing a decision, as opposed to being forced or locked into, well, I've got one choice and that's it. So what about taking the monthly amount? What choices there? We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. It does seem crazy, but I've had a handful of folks where you're like, okay, both Social Security, you've worked a long time, so you're both, drawing Social Security at 67, 68, whatever. One maybe has another pension. And so you look and you're like, geez, between that, there's $6,000 of monthly income.
Yep.
That's all you need. You've got this other $2,000 monthly pension. Do you really need it?
Right.
Yeah, you're talking about the flip side of what Josh and I were talking about.
Right.
Because you say, all right, I don't have enough monthly income, or I have too much monthly income. And you say, well, if you have too much monthly income when you're 67, you're definitely going to have it when you hit 72.
Right.
Or
82. Right.
No. 72.
Oh, yeah.
For the
R&D.
required minimum distributions.
Yeah.
Right, which, they're talking about moving that to 75.
Right.
So who knows? But I think that is, if you looked at your pension and you could say, no, the pension is the perfect amount of fixed income along with the perfect amount of Social Security, and I would never adjust anything, then maybe you're not thinking in terms of lump sum. But if you said, I want to have any kind of control over this.
Well, this third segment, so we're going to talk about the monthly amount, and we can talk about life only or joint and survivor and those options. We can talk about pension max.
Yeah, and because the other thing I can't do is I can't do QCD
Right.
with my
With your pension.
YMA.
Yep. All right.
Okay, and I'm zooming at 10.
Okay. Well, we're still on track to be done at a good time, so maybe I can squeeze in a nap. Still just feeling like, and we got to leave at 6:30. We have to be on the road at 6:30 a.m. tomorrow.
Wow.
Yeah.
In the morning?
Baseball?
Yeah.
This is the big tournament?
Last week was the big
last
tournament.
2 weeks?
This is even a slightly bigger. But
Yeah.
last week was the big deal. This one is, we want to do well, but
Less likely to win something like this.
I would have been devastated if we were really close and lost last weekend. This one, it's like, we probably will lose. Like, there's some really stinking good teams. So, less pressure. All right.
Always.
Yeah.
If you have a pension, and there's no lump sum option available, or maybe you're working with your certified financial planner and it's advised don't take the lump sum, what are your options with a monthly payment amount, and how do you make the best choice? What's the wise choice? We're helping you with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on the YouTube channel. Go check it out. Go to YouTube, search the Wise Money Show, and subscribe to it there. And subscribe to it and turn on notifications, because not only is every episode of the Wise Money Show there every single week, but all throughout the week we're adding additional content, next wise steps, different financial topics that we're applying directly to your financial life to help you take your next wise step. So if that sounds like what would be beneficial to you, go to YouTube, search Wise Money Show, subscribe to it there. Okay, guys, so the pension decision, for those of you that have it, if there's a lump sum option, boy, you got to be talking to your CFP about that. And you got to build a plan and look to see which one's best. I would say for the average person, capturing that flexibility is going to be extremely important. But what if you don't have that flexibility even as a choice? There is no lump sum option, and you've got to take it monthly. What are your choices then? Let's first talk about, if it's monthly income, you still have some choice.
Yeah, you do. The default, though, is, I made the comment earlier that a pension represents a stream of income that you won't outlive. And the reason I say that is that the default is the pension company does a calculation based on your life expectancy. They've got tables. They've got all the data. They have the statistics that say what are the odds that you're going to pass away at any given year or any given age. And however long you're going to live, they spread those payments out to basically match your life expectancy. And so, and yet, if you defy the odds, you're one of the statistical anomalies that live a long, long time. Guess what? They're on the hook to keep on paying you for your entire lifetime. The problem is when you pass away, the income stops unless you've made a selection to also build in a survivor benefit or think of a beneficiary. If you're married, then your spouse has a legal right to receive a survivor benefit. So in order for them to pay over your lifetime or as long as your spouse lives, they're going to reduce that income. So you get a lesser amount, but it's at least guaranteed to keep on going for as long as your spouse is alive.
The 100% survivorship option, the same payment will continue as long as your spouse is alive if you pass away. But there's a 50% joint survivor where you get a slightly different
bigger payout during your lifetime.
Correct. And then your spouse would receive half of that. They've got 25%, they've got 75%. You could even add in some period certain where you're going to get this payout will last for at least 20 years or at least 10 years, whether you're alive or not. The trick with that is, what if that beneficiary passes away? And most people, I've got a client who had a pension, didn't have a lump sum option, and his wife had already fought cancer twice. And so, not to be cruel, but to be planful, we said, well, it probably wouldn't make sense to draw this pension and take a lesser amount so that it continues if you pass away before she does. However, we still need to protect the pension, so let's get some life insurance. So if you draw your pension and the very next day you pass away, there's some resources to your spouse. The pension would stop immediately, but life insurance would pay out. We're going to talk about that in a little more detail. And but you're going to get the full pension amount. Well, it turns out she had yet a different kind of cancer show up 9 months after he retired. And sadly, it took her life within 6 months. Wow. And so now he's still getting his full pension amount. And he's keeping life insurance around for now for the kids, just in case. But he's got lots of flexibility. So tragic situation emotionally and in life. But from a financial standpoint, we made a wise choice.
So there are some times when you would take the largest possible monthly payout, even though it will only go for your lifetime. If you're single, you're not even married, there's not a spouse that you need to be caring for, then clearly you would take the largest possible payout or a lump sum amount if that was an option. Mm-hmm. So
this is interesting because if you're single and you're coming up towards retirement, I've seen this scenario where there was someone, a client who was single but was considering marriage. And the pension election is kind of a hard deadline to, hey, if you're married, you have one set of options. If you're not, you have a different set of options. Mm-hmm. And this is what I've always told people is, listen, when you go to retire, if you have a pension, you're going to likely buy insurance. You're going to buy a big insurance policy. And they're like, well, I'm not going to buy insurance. I'm done with insurance. I'm tired of that. No, you're going to buy insurance. You're either going to buy it on your own and privately write a check to the insurance company, and you know what that deal will look like. If you don't do that, you'll buy it from the pension company. And through the pension company, that insurance looks like, okay, you have a $2,000 a month pension, or you have $1,500 a month for you, and if you die, your spouse gets $1,500 a month. So basically what that means is there's a $500 a month premium forever for a declining amount of insurance. And then you say to the spouse, hey, would you rather get $1,500 a month, or would you rather get $200,000 in the event something happened to your spouse?
A life insurance policy, life insurance payout. Yep.
So this is where people don't really understand fully the idea that, hey, there's a big life insurance purchase here, and so framing it in a way that I mean, we can take the very simple and break it down and make it very complex, and so framing it in a way that people really understand can be really helpful.
Well, but what you're describing is through the financial planning process, you identified a scenario or a method, a strategy that was not on their radar screen anywhere.
Sure.
And because again, this is being framed to you as you have to make this pension decision, and then you have to live with it for the rest of your life. And boy, if there was ever a type of a decision that you should just slow it down and really make sure that you have identified all the choices that you could be making, because maybe the handful that are obvious are not the best ones. It's the one that's a little bit hidden from your view that really should be considered. And that's the whole point of financial planning. It's the reason why you have a certified financial planner in your life, someone who can help you expand your options when you're about to make a lifelong, commitment, essentially.
I mean, it's good versus great, right? Because what you're talking about, Kevin, is if you've got a pension that you can't take lump sum, or you won't take lump sum, you're going to make a life insurance decision. You absolutely will. And do you want to have all options on the table and pick the great one, Wayne Gretzky, or do you want to just say, well, let's hit the easy button here? And I would argue there's too much at stake. There's too much at stake. These are thousands of dollars, if not hundreds of thousands of dollars. There's tax implications. There's legacy and inheritance implications. You got to make a planful choice.
That's right. And that's why you don't consult with folks who did make the easy choice, who didn't expand all their options, because that might be, your instinct is to talk to the person who retired a couple years before you. Hey, what'd you do? How's it working out? They may not have taken the right process themselves.
Once again, this just emphasizes the point that there are 6 areas to your financial life, and you can't tackle a financial choice in one area in isolation. You've got to look at all 6 areas, how they tie together, because your pension's an income choice, it's protection planning, taxes, of course, investments, retirement, and estate planning. It's all of them. Make a wise decision with your CFP. All right, we've got more to come here on the Wise Money Show with Korhorn Financial Group. I have almost lost track. I'm saying it's 4-segment Land the Plane.
I think you're right.
Yeah, okay.
Phil, you good with that?
All right. So let's just transition to questions. Phil. Is there anything, I mean, I don't think we left any real meat on the bone there. I want to hit Eric's question first about inflation. And then we'll go to James's. They'll probably be done. Is inflation still a concern, or is that old news? How do you prepare your financial life for what could be ahead? The certainty of uncertainty. That's what we're talking about right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn has a smile on his face right now. I don't know why. I don't know. And then Josh Gregory's here as well. Listen, if you listen to podcasts and you've missed anything on the Wise Money Show or like what you're hearing, you can catch every previous episode on podcasts. Wherever you listen, search the Wise Money Show. When you get there, subscribe to the show or follow us there, and then rate the show as well. That helps other folks find us, and it gives us feedback as well. You can leave comments there too. We appreciate it. All right, so we've been talking about pensions and making a wise choice when it comes to your pension. I would say the same applies with your defined contribution plan. That's geek speak for 401k. There's lots of legislation designed to try to combat this retirement readiness crisis. I would argue it's not a legislation problem. Personally, it's not. It's a financial wisdom. It's a choice. It's a decision problem. And we believe that solution is comprehensive financial planning. And so that's why we're on the radio, preaching this, because so where I was going to go with that is, what they're trying to do is turn defined contribution into defined benefit. They're trying to turn your 401k into a pension plan, an income stream, and lock up your options. And I say no thank you, Mr. or Mrs. Congressperson. No thanks. I want choice. I want options. And so even if you've listened to this and said, I don't have a pension, doesn't apply, it might in the future. So be wise, be proactive with your financial life. Sorry, Josh, I cut you off.
No, I don't really have anything more to add to that. I agree with you, though. It's one of those reasons why we do a show like this. It's to educate you as a listener on topics that you wouldn't just naturally want to think about on a Saturday morning. Maybe you feel like it doesn't apply today, but these are concepts to tuck away in the back of your mind, because you will be facing these types of issues. If for no other reason, if your life doesn't change, the rules and the context that you're making your choices can change every time Congress gets out their pen and starts writing new laws.
Yep. All right. Speaking of, potentially a side effect of what Congress has been doing, Eric from Toledo, Ohio, reached out with a question. Everywhere I turn, I am reading things that tell me I should be bracing myself for runaway inflation. Do you agree with that outlook? And if you do, what should you do about it? Now, first comment I would say, Eric, number one, thank you for listening. And I'm not sure if I think that question came from the YouTube. So thanks for checking us out on YouTube. Second, now this is so geeky, but we're into August here. So we're just about done with earnings season, where companies report on second quarter earnings. And they usually report those with a write-up. And sometimes they report those with a write-up and a phone call or some sort of announcement. And I saw 86% of write-ups or verbal communication from S&P 500 companies included comments about inflation. 86% of the largest companies in the U.S. talked about inflation. And now, whether you're seeing it or not, if you run a company, you've got a choice. You've got a very, very tricky choice. Price increases are either going to be forced upon you by your vendors, where you're buying their product to then make into your widget and then pass along to customers. So those price increases are going to either be forced upon you and will eat into your margin, or you can begin to raise your prices as well. And to me, even if lumber prices have come back down a little bit, or even if the Fed is saying, don't worry about inflation, it's not here, it's transitory, it's temporary, don't worry about it, businesses are talking about, do we get ahead of this thing and increase our prices so that our margins aren't damaged? And you better believe 86% of them are having that conversation and doing it.
That's right.
Well, they don't. Here's the thing: businesses live and work and operate in Realville. So when you're a business owner, and I just talked to several this week, and they're saying, "Hey, listen, I sign contracts at the beginning of the year to provide certain goods and services at a certain rate, and the cost of everything for all of my inputs has gone up dramatically, which means." But the price is locked in,
right? Because
I've signed a contract. So basically, what is happening is my profit is getting squeezed like crazy right now. And so you've got to believe that when it comes time to do those contracts a year from now or at the end of this year, they're going to be reflecting an increase in prices. And the guys that don't increase their prices are going to find themselves out of business.
That's right. And I think what you're kind of hitting on here is that not every business has the same ability to absorb or pass along inflationary pressures. Some people are locked into contracts, as you were describing, Kevin. Some large companies they do some very careful and sophisticated hedging of expenses. They buy certain contracts out in the future to protect the prices that they're getting their raw materials at. And I think we're starting to see, I've watched a lot of the headlines here recently on many of the food companies finally starting to see price increases that they have to start taking because some of those hedges have worn off, so to speak.
Exactly right.
They've gotten through all their cheap raw materials, their milk, their eggs, their whatever, and now they're into, okay, we're right back to real-time, current day prices, and it is a spike. And so you're going to start seeing some of these prices finally making their way through. Not every industry has been raising costs at the same rate because of these types of conditions.
Now, the flip side of that, before we directly answer your question, Eric, just adding perspective, the flip side is markets, the free market, if there is such a thing anymore, is rarely wrong. Okay, things change quickly, so you can see the stock market do one thing today and do the very next thing, do the very opposite thing the next day. You wouldn't say, well, they got it wrong yesterday, they're getting it right today, or vice versa. No, things change. Things change quickly. But the whole idea of some of the smartest people on the planet all making their guesses about what's happening and averaging those guesses into today's price, they typically get it right. The bond market and interest rate market is saying inflation's going to come down. Here's the problem with that, though. The bond market currently is not operating the way it's supposed to. Mm-hmm. You've got the biggest bond player being the Federal Reserve. If you look at how much of treasuries the Federal Reserve owns, it'll make you sadly distrust capitalism and big government. Sorry for throwing that out. I just if you look at how much is being manipulated, you would say I don't trust it. So you look at the bond market and you'd say, nah, inflation will probably cool off. But then you look at who's buying the bonds and who's pushing rates, and you say, oh, maybe not.
Yeah, it wasn't that long ago. Maybe 10 years ago, when you'd ask the question, well, who's lending money to the federal government, the U.S. government? China.
Yeah,
that was the answer. Right? They had a couple $1 trillion at the time of our debt. And they are not the big buyer, the big lender to the federal government anymore. Now it is the Federal Reserve Bank, our central bank, essentially printing money and then lending it to the U.S. And what you're hinting at is that causes kind of an unnatural, maybe manipulated is the word, or at least
influenced.
Yeah, influence is maybe a more fair word. A market that's not behaving as normal. Normally, as inflation worries go up, interest rates also go up to try to account for that. Mm-hmm. But that's being kind of held in check right now because of all the buying that the Fed's doing.
So, Eric, would we agree with the outlook that there's going to be runaway inflation? I probably wouldn't say it as strongly as runaway inflation, but my goodness, we are seeing inflation. It's hard to expect that the cat just goes right back in the bag.
I would frame it differently, Eric. Because one of two things is happening right now. Either the cost of goods and services is going up, or the value of the dollars that you have in your wallet is going down. And I personally believe, and I'm an optimist, but I do believe, here's the problem. I believe my eyes. And I work with business owners that don't have the ability to say, hey, the CPI is based on these certain factors, and we don't like the way that it's going, so we're going to take this component out of it, and we're going to add this component back in, or whatever we're going to do. Because you know, figures lie and liars figure. You can manipulate the number, the CPI, and the CPI has been horribly manipulated, but you can't manipulate the price of gas when you pull up to the pump.
Yeah.
Like, inflation is inflation. It costs more. It cost 50% more to fill up your tank than it did at the beginning of the year. That's real. That's a real cost. You can't explain that away with some sort of percent.
So then maybe we should just go to the second part of the question. If so, what should you do about it? Now, I'll start there and say it's not to start building some hedges. I would tell you, if you want to prepare for inflation, focus on your present financial position. That's the first one. I mean, to me, you want to make sure that you have a solid budget, solid 3-bank account system, solid cash reserves, not where you say, well, the inflation's coming. I better buy everything possible. I better borrow as much as I possibly can. I better take my cash and do something with it. No, oftentimes periods of high inflation go along with some distortions and disruptions in the economy. You want to make sure you've got a solid financial foundation.
I would also say, Eric, we don't know your age, but the younger that you are, the more important it is to recognize the long-term effects of inflation as well. We've come through a couple decades of really low inflation, and a lot of people have been kind of lulled to sleep by that. We have always said that inflation is one of the risks that you have to be able to manage when you're looking out long-term into retirement. And you need to be building up resources, a nest egg that can support you, and not relying upon things that are more of a fixed income like Social Security. You have to be able to stay out ahead of inflation because you own assets that can grow and appreciate even in the face of inflation.
That's right. And the stock market has been the best type of investment to combat long-term inflation. So great question. I hope that helps. That's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at KFG, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.